Hey guys, I'm here with Hugo from Vine Group, one of our regular guest speakers, and I've been hearing about this laneway financing. And be very frank, I don't know very much about it. It's a very salacious title, though, so I'm hoping to learn a bit more about it
Quickly.
today. And I know Hugo's the expert in this stuff, so we're just going to pepper him with questions. So maybe you can start off with telling us in general what the program's about.
Yeah, so the lenders I've always said are a little bit slow to catch up to trends. The banks are generally going to be more conservative. So as an example, when we had micro condos, so in our definition, anything under 500 square feet, a lot of banks didn't want to touch those properties for financing, and the ones that did required a larger down payment. And it took a little while, to adapt to that reality that this is the marketplace in big urban cities like Toronto, for example, and there's a demand for this product. So eventually, I would say most lenders now are completely fine with micro condos, and we're seeing like 350, 300 square feet, no problem, right? So they've caught up to that. One trend that we've been seeing a lot of, and this, is laneway houses. The reality is with the traditional laneway house, you have your main property, and then you're looking at building another structure in the back, usually in laneway. Now the banks had different ways of approaching it. Some lenders will treat it as a regular refinance on an exception, meaning my place is worth $1 million. I've spent whatever it is, $500,000 on this laneway house. Now it's worth 1.5 or more. I'm going to refinance that. That's kind of the expectation. That's not always the case. Some lenders will not acknowledge the laneway house, especially because it's a relatively new product and the comparables might be difficult to assess. So to a bank who's giving you money against the value, they might not be comfortable giving you full credit for the laneway house. And that creates a problem because as I go into a project, I don't know if the bank is going to give me acknowledgement for that laneway house. Because a lot of banks will say to you, it's all case by case. You got to send us a file with the appraisal, everything done, and we can let you know. So how we were circumventing that sort of was going to a lender with an appraisal that had the complete value, just like you would with any construction type financing. And the banks would work backwards and say, we can arrange financing. So that was how we were doing it. So it was almost very Frankensteinish. We're like trying to put pieces
Piece
together and
everything
trying to put
together.
these things.
Yeah.
So one lender, which I won't mention their name and give them any credit, but a great lender, they've actually specifically come out with a laneway house program for Toronto and Vancouver markets as a pilot that they've launched through us and are releasing to the industry. The idea is basic. They will help you arrange financing for either a purchase of a property and then construction, or if you're already own the property, it will help you with the construction financing piece. So both options, right? The nice thing about them is that there's very clear direction from beginning to end on how much you're going to get, any costs or rates or so on, so that you can plan and work with your team, your Volition team, and the rest of your team on getting this to the finish line. Um, so that's kind of the gist of it. It is in terms of the lending amounts. Again, it's all case by case, but they will go up to. I'm just checking here. Minimum loan size is about 200,000, and they will go. There actually is no real cap, so 2.5, 3+ million. All that stuff is very doable. So it's really just knowing that there's a financing solution that will help you take you through the whole process versus kind of rolling the dice or going with these half-baked solutions where you're borrowing from one lender maybe for another or refinancing another property to do all this. So those are still attractive and in some cases could be better options, but this is sort of a turnkey type solution that we're happy to be able to be part of their pilot. So that's kind of in the gist what's out there right now.
Okay, that's pretty cool. So just so to summarize, make sure I'm understanding. So when somebody is looking to build a laneway house independently, or maybe as part of a greater part of construction, you can go to this lender. They'll look at your plans, assess the value ahead of time, so that way they can lend you as like a construction loan at the beginning. Is that would be the idea, or is this
Just on this specific point, they'll lend up to 75% of the final value, so 75 loan to value,
okay?
or 80% of your cost of your budget, basically, depending on which one you need. So that, for the most part, you're getting most of the funds out. And if there's an improvement in the value, then there's a possible ETO or equity takeout that you can also extract if you're able to increase the value further.
Okay, like this is pretty compelling because there's usually not, well, as you mentioned, there's not a clear solution right now when it comes to laneway homes, right? You can build them, and then oftentimes you try to get your money back from the construction and the added value of the property, and you're seeing nothing, right? Like they're too new, hard to assess values of. You get a little bit of security going this way.
It's also, let's be honest, in an ideal world, you already own the property, maybe a small mortgage on it, lots of equity. We put a huge HELOC on it. Then you use that HELOC and just go to town. It's super easy solution and it's fully open and so on. But I would say in a world where a lot of investors generally are going to be pretty leveraged because they're always acquiring and growing portfolios, it's rare where someone approaches me and says, I have this $1.5 million property, $100,000 mortgage, and I want to put a laneway house. I would say to them, well, obviously this product makes no sense. Let's just put a big HELOC and then use that to control your expenditures. And when completed, we can then refinance it if you want to. This is more for that consumer that maybe doesn't have that option and they need a bit of help with the construction piece. So that's kind of, the gist of it. It is like a 1-year open type term, interest only payments. So the idea is to get it to the finish line and then you can either restructure, refinance with the same lender, or you can go to another lender if you're finding a better home or better rate and so on, now that you have a complete product. So yeah, that's the gist.
Yeah. What, big question here. What sort of rates are you looking at for loans?
The rates are pretty, the thing is the rates are not bad. So because it's an open term, and as a reference, a benchmark open term would be like a HELOC. So as of today, early September, HELOC rates or prime is 6.45. So for any of you guys that have a rate of prime on your HELOC, that's like AAA, that's normally the best you're going to get. So that's kind of the benchmark. This product is prime plus 2. So what is that? 8.45 for a fully open product. That's the idea, is that, it's open. So the rate's going to be a little bit more, but you have to compare like the alternative. The alternative is you lock in for a year or two. You're probably still going to be in the 6s or higher anyways with the average lender today. And there's risk of penalties once you're ready to get out of it or break it. This is just a fully open solution, prime plus 2 interest only. So yeah, it's going to be a little bit more expensive, but this is not unusual for construction type financing options anyways. Generally, the banks want you to be open, but the traditional type lenders for construction financing wouldn't do a laneway house financing. Generally, it's like home, purchase and improvements, which is like, I want to renovate a kitchen or whatever. Generally smaller type projects or what they're looking at.
So would this be, you mentioned interest only payments. Is it like interest only payments throughout the project, or is it like a balloon payment at the end?
That's a good question. Just monthly interest only payments on this. Now the lenders will also use the rental income from the new suite to help service the file too, because at the end of the day, you still need to service this. So on a rental, on a laneway home that could generate whatever, $3,000 a month, that could be used to service and help the math here as well. Also, the servicing on this, it needs to make sense, obviously, but the servicing on this does have larger parameters. So it's a little bit more generous with exactly how much they'll lend to you, and their sandbox is a little bit bigger than your normal type lending. So yeah, again, something that I think is interesting in a world where rates are slowly coming down and we're seeing values start to be supported again, depending on what type of asset, and we're seeing those little increases and tiny little bidding wars start to happen depending on where you live. I think this is an attractive way to say, hey, you know what? I already live in this place. I've got a pretty sizable backyard that meets laneway house criteria. Perhaps it just makes more sense for me to put a laneway house there versus acquiring a new property that is gonna be a lot more expensive. So I think for some it's attractive. It could also be attractive for others that are in a point of their lives where maybe they want to downsize. Perhaps you don't need. Your kids are leaving the house, and it's, as an alternative to moving to a condo, I know some clients that have rented their main home and have moved into a laneway house instead. So there's all kinds of applications here. And also, more importantly, I think as a marketability, there's value from a financing perspective, someone buying a home that has laneway potential, because it helps subsidize the cost of your loan and will allow you to get to a higher price point, which usually comes with more desirable neighborhoods, which you would have otherwise not been able to afford because your cash flow doesn't make any sense. So this is a great product. And I think there'll be a lot more of these in markets like Toronto and Vancouver, because housing's so expensive. So yeah, I think I've seen some amazing laneway homes that just look like little mini hotel suites with, so it's cool.
Pretty cool
with the privacy. Yeah.
Yeah, but it is great to see this happening. Like you mentioned, it takes a little while for banks to catch up. It's nice to see that they are getting to this point. If people
Definitely.
want to learn more about this, how do they find you? How do they get a hold of you?
I think, reaching out to us through our webpage, I think we'll post it all over this video. So it won't be hard to find myself and the team to have a conversation, but also engaging with the team at Volition around, hey, does this make sense? On your investment journey, is this type of thing the right one for me right now, or are there other opportunities? So I think this is, like you said, a positive step in the world of financing, where we've seen investors are generally not the favored, end user for some of these new solutions, but it's great to see something like this come out because, it means that there's a little bit more options for investors in our world here.
Yeah, absolutely. Always appreciate you having you
Thank you,
coming
man.
on to these calls, and I always get a chance to learn from you. So thanks a lot, Hugo, and you'll
Thank
have
you for having
all
me.
the links available in the post to follow Hugo. And of course, if you want to learn more about real estate investing in the city, stick around. We try to get some good information out as often as we can.
Thanks so much, man. Appreciate it.
Thanks.